Ladies and gentlemen, good day and welcome to the Escorts Kubota Limited Q4 FY23 earnings conference call hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we start, I would like to add that some of the statements that the company makes in today's call will be forward-looking in nature and subject to risk as outlined in the annual reports and investor releases of the company. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services Limited. Thank you, and over to you, sir.
Thank you, Michelle. Good evening, everyone. On behalf of Emkay Global Financial Services, I welcome you all for Escorts Kubota Limited Q4 FY23 earnings conference call. I also take this opportunity to welcome the management team from Escorts Kubota Limited. Today we have with us Mr. Bharat Madan, Whole-time Director and Chief Financial Officer, Mr. Harish Lalchandani, Chief Officer, Agri-Machinery Business Division, Mr. Sanjeev Bajaj, Chief Officer, Construction Equipment Business Division, and Mr. Ankur Dev, Chief Officer, Railway Equipment Business Division. As well as we have Mr. Pratik Singhal, Investor Relations and ESG at Escorts Kubota Limited. We would start the call with brief opening remarks from the management, followed by an interactive Q&A session. At this point, I would request management for their opening remarks. Over to you, sir.
Thank you, Chirag. Hi, good evening, everyone. This is Pratik Singhal. Thank you all for joining us on the earnings call for the fourth quarter and fiscal year ended 31 March 2023. Few highlights of the company's standalone performance for the fourth quarter ended March 2023 are as follows. Revenue from operation during the quarter was up by 16.8% at 2,183 crores as against 1,869.6 crores in previous fiscal. On sales volume front, tractor volume was up by 13.1% to 24,765 tractors as against 21,895 tractors last year same quarter. On the construction equipment volume are up by 18.8% to 1,528 machines as against 1,286 machines in the last year same quarter. EBITDA for the quarter ended March 2023 came at 235.8 crore, down by 6.2% as against 251.5 crores last year same quarter, and sequentially up by 23.9% as against 190.3 crores in Q3 FY23. EBITDA margin for Q4 up by 240 basis points to 10.8% as against 8.4% in sequential quarter and 13.5% last year same quarter. PBT before exceptional item at 271.4 crores as against 269.5 crore last year same quarter. Net profit at 185.5 crores as against 202.2 crores last year same quarter, impacted due to exceptional provision of rupees 24.4 crores on account of impairment of investment in the wholly owned subsidiary Escorts Crop Solution Limited. Company continue to be net debt free with sufficient availability of liquidity for growth. The Board of Directors has recommended a final dividend of 70%, i.e. rupees 7.0 per equity share for the year ended 31st March 2023. On consolidated basis, company financial performance for the quarter ended March 2023 is as follows. Turnover is up by 17.4% year-on-year to at rupees 2,214.4.5 crores. EBITDA margin at 10.5% as against 13.2% in last year same quarter. Profit before tax up by 7.8% year-on-year at 277.6 crore. Net profit margin up by 13.9% year-on-year at 216.5 crores. Moving on to the segmental business performance, starting with the agri-machinery business, the total tractor industry volume, domestic as well as export, in FY23 went up by 10.2% to 10.7 lakh tractors as compared to 9.7 lakh tractors in the previous year. This is a new record for the tractor industry, beating the last peak of 9.88 lakh tractors in FY21. Our total volume went up by 9.7% to 1,03,290 tractors as against 94,228 tractors in the previous fiscal. Our total market share was maintained at 9.7%. Key to note that this is the second time that company has crossed 1 lakh plus tractor sales unit. The domestic tractor industry went up by 12.2% to record number of 9.45 lakh as compared to 8.4 lakh tractor in the previous year. All macroeconomic factors, crop production, crop prices, good monsoon, and availability of retail finance remain positive throughout the year. Our domestic tractor volume went up by 9.4% to 95,266 tractors as against 87,043 tractors in the previous year. We ended the year with a domestic market share of 10.1% for FY23 as against 10.3% in FY22. The marginal drop in the market share was mainly due to drop in Q1 FY23. Post that, we have taken corrective actions in the last 9 months of the fiscal from July 22 to March 23. Our domestic market share improved to 10.4% as against 10.2% for the same period in FY22. And in Q4, we ended market share at 10.9%. We have more than 1,200 plus dealer count. We continue to focus on channel expansion to cover the white spaces for both PowerTrack and FarmTech brand. We have also initiated steps to focus on the health of our channel and are taking a step to develop a strong and healthy dealer network. On the export side, during fiscal FY23, industry was down by 3.2% at 1.24 lakh tractor as compared to 1.28 lakh tractor in the previous fiscal. However, our export volume went up by 11.7% to an all-time high of 8,024 tractors as against 7,185 tractors in the previous fiscal, driven by our continuous focus on new product development and expansion of our distribution network. Sales through Kubota Global Network is also gradually increasing and during the year contribute more than 30% of the total export volume. Segment revenue was up by 13.5% to 6,316.1 crores as against 5,563.7 crores in the previous year. EBIT margin for the agri-machinery business stood at 9.3%, impacted during the year by steep inflation in commodity price, adverse product mix, and impact of price rationalization in certain products of the geographies. For the quarter ended March 2023, EBIT margin was up by 159 basis points to 9.9% as against 8.3% in the sequential quarter, led by a better product mix, improved price rationalization, and softening of the commodity prices. In Q1 FY24, domestic tractor industry is expected to remain almost flat due to advancement of the key festive season to March 23 as against April last year, combined with unseasonal rain. However, for FY24, we expect the domestic tractor industry to do well and may register low mid-single digit growth, led by positive macroeconomic factor on account of good Rabi harvest, improved crop prices, and adequate water level reservoirs. Coming on to the construction equipment business, our serve industry of crane, backloader, and compactor was up by 24.5% in volume as compared to FY22, led by growth in backloader industry of 28%. Crane industry was up by 20%, whereas compactor industry see a degrowth of 5%. Our total volume of manufactured and traded products went up by 12.2% to 4,620 machines, as against 4,117 machines in the previous year. Segment revenue went up by 19.5% at 1,179 crores, as against 986.8 crores in the previous year. EBIT margin went up by 48 bps to 2.9% as against 2.4% in the previous year. There is a sustained demand for construction equipment industry, supported by government continuous thrust across all infrastructure. We expect demand momentum to continue going forward for the current quarter and further accelerate in FY23-24, and margin for the segment to improve further, owing to softening of the commodity price and improvement in the product mix. Coming to the railway division, revenue for the year ended March 2023 went up by 32.3% to our ever highest yearly revenue of 841.9 crores as against 636.2 crores in the previous year. Sales from the new product contribute 65% of the total sales, division sales. EBIT margin for the year ended March 2023 stood at 13.8% as against 14.8% in the previous year. Order book for the division at the end of March 2023 stood at a healthy and ever highest level of more than 1,050 crores. With continuous focus on product diversification and export, we expect the railway equipment business segment to continue in the double digit in FY24. Now we'll request the moderator to kindly open the floor for the Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi team. Thanks for taking my questions. I have two questions. Firstly, on the outlook for the industry, I'm not sure if it was flat for F24 or low single digit. If you could clarify that, and also give us some color on how did the recent festive go, in any color on the geo trends, where are the inventory levels, some color on the industry, what you're seeing on the ground.
Thanks, Gunjan. This is Harish here. To give you our perspective of the industry, we expect the first quarter of this year to be flat, given some of the adverse weather conditions, but overall for the year we expect the industry to grow by single digit. That's for F24.
Okay.
Going by the trend in the festive season in quarter 4 was, if you were to split the quarter into two parts, the first part of the quarter was good for us because of good rainfall, good water supply, etc., good MSP prices. The last month, which was March, got impacted positively as well as negatively. The positive impact was because of the festival. Negative impact was because of unseasonal rains in a few markets.
Okay. And on balance, did it go as per your expectation? Was it growth versus if you compare with last year, Navratra festive? Did these balance out each other, or was it skewed more on the negative because of the unseasonal rains?
If you were to ask us if the unseasonal rain hadn't happened, and if you see the trend versus the previous quarters, the growth could have been better. But given the fact there was unseasonal rains, the market still grew 14%, but it is not in line with the growth in the previous quarters.
Okay. And where are the inventory levels? Is there some higher inventory levels because it didn't go the festive didn't go as anticipated?
Actually not, because if you take a look at our quarter 4, our deliveries have been higher than our billings. Therefore, our net inventory at the end of quarter 4 stands lower than it was in the previous quarter.
So less than a month, I should assume.
It is in line with the 4 to 4.5 weeks that we normally have.
Okay, got it. The second question is more around the margins. Now, we've seen some sequential improvement given, combination of mix, price hikes, as well as, the cost easing. But if I were to look ahead and, for going by the assumption that, there's incrementally not much of operating leverage to play. If it's a flattish or a low single digit volume growth, there's not incrementally much operating leverage as a lever. So how should I think about the various, push and the pull factors? Like, do we have scope to take more price increases? Are we expecting more commodity easing to flow through? So, just some perspective on how I should think about margins for F24 for the agri business.
Hi, Gunjan, this is Bharat Madan. So as you rightly mentioned, operating leverage, we are not really banking on too much. But if you look at the trend in the last 2 quarters, so we are getting the benefit of the softening of the commodity prices, and looks like the trend will continue in the coming quarters too. So price increase does not look like a feasibility in this scenario when the commodities are softening. So that is something which we are still keeping a watch. It will all depend on how the competition plays out, and if there's a possibility, so that will be explored. But right now it looks difficult looking at the way commodities are moving. But as we mentioned in the last quarter, so that was the bottom out quarter for the margin perspective, and we are only looking at better margin coming in going forward. So this commodity cycle obviously is giving benefit going forward too. So we expect that trend should continue, and that should actually lead to some better margin. In addition, there are also some cost control measures which company had put into place for this year. So that should also start playing out. So that also should add to the overall bottom line. So our days by the time we exit the year, we should be at least back to what it used to be the normal level of margin for tractor business.
The normal, you mean the low to mid teens, because we've gone through a huge range in last 2.5 years, right? 13-14%, then we touched even 20%.
I think COVID year you should exclude. So I think pre-COVID level, which used to be just 14% sort of range. So that is the sort of number which you're targeting to end the year, this year with, as an exit.
Okay, got it. Just last question, if I can pitch in, this construction segment margin at 8%, is this sustainable? Is it one of this quarter? Any clarity on that?
So construction, as you know, I think the demand started picking up only from December last year, and only second half in construction equipment business is good. And you have already seen the margin historically also, the last quarter used to be the best in terms of the margin. The whether the same numbers will sustain, I think difficult to say, but the demand momentum is continuing. We're seeing good numbers coming in April also. There's some spillover demand which was there. So industry is right now struggling with capacity issues, but there's very good demand coming in both domestic as well as an export front. And given the demand scenario for this year, we expect the momentum should be good. The price increases have been absorbed in the market. So the idea is the margin should continue to be better than last year. Now, whether this same level will sustain, I think it's difficult to say at this point in time.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Jain from Emkay Global Financial Services. Please go ahead.
Thank you, sir. I have a couple of questions. On the market share front, within the tractor space, we have seen a decline last year. So how do we see that shaping up this year, and any major initiatives that you can call out which can help in terms of boosting our market share?
Hi, Chirag. Thanks. This is Harish. Chirag, again, if you take a look at the full year, okay, and if you take a look at the sequential quarter-wise, quarter on quarter, we have increased our market share from Q1 to Q2 to Q3 to Q4. Okay. Biggest drop that we had was in Q1. Subsequent to that, we have always grown in our market share. So that is point number one. Two is, this has already some initiatives have been taken. Key among is the focus on digital. Second is our focus on the 31 to 40 HP, our focus on the 41 to 50 HP, as well as our focus on greater than 50 HP. Second is in terms of geography, our focus on the strong as well as the opportunity markets, which is leading to a significant growth of share in the strong as well as the opportunity markets across quarters. The third is our focus on the haulage segment. So we see haulage segment as an opportunity for us going forward, and even in the last year, we have made some inroads into this.
Okay. Second question is with respect to the product mix, or let's say the segment-wise, let's say growth profile within the tractor space, let's say agri and non-agri. How do we see that, let's say, in this financial year? And this could have some implications on the margin profile as well. Maybe if you can discuss that as well.
The two bits. If you were to take a look at the market today, if you were to take a look at the pure non-agri, our estimate of the non-agri market is approximately 15 to 20%. And if you take a look at that specific market, that is predominantly driven by investments into infrastructure. Given that the government has the stated intent to double the spend in infrastructure this financial year as compared to the actual spend last year, we see the segment showing a significant growth. That is part one. Agri, if you take a look at it, given the current water levels that we have in the reservoirs and the positive trend that continues into this year, we also see a positive momentum in that segment.
Okay. So just last thing, and then I'll come back in the queue. In terms of TREM 4 regulations, any update do we have? I think in the last call we mentioned that it might come probably in September 24. So any final notification or any update that we have?
So no further update. It is just that as part of the TMA, we have submitted a recommendation to the government to try and keep a 5-year gap between the TREM 4 and the TREM 5, but they are still to get back.
And also, in last call we had mentioned in the original emission norms for more than 50 HP even got delayed by almost 18 months. So we expect similar delay should be there for the lower HP segment also. So earlier the initial change of emission was supposed to happen from 1st April 24. Now if you look at 18 months delay, it would have been September 25, not September 24. So, but right now obviously there is no notification being issued, so we are still waiting, and we will come back once the discussion is out and the notification is out.
Okay, thank you so much. I'll come back in the queue.
Thank you. We have the next question from the line of Devika Jain from Ratnabali Investment Private Limited. Please go ahead.
Hi, sir. Good evening. Thank you for taking my question. So, we have grown our exports by nearly 12%. I just wanted to understand how our peers have performed and the reason for our outperformance as against the industry.
So industry has actually declined by almost 2% last year. So exports in India have not done well. So the industry total was roughly 125,000 this year, against 129, 130,000 year before. So in our case, the exports have grown because obviously we have started exporting to quota network also, which was also one of the reasons. So almost 30% export in our exactly this year was through quota network. And that's the trend we are seeing probably will continue. So that's why we are more bullish on the export number going forward too. So in the industry scenario, with some of the countries have started facing recession, especially in EU countries. So we are seeing some sort of recessionary condition are prevailing because of this geopolitical issue. And the US also is expected to get this recession mode. So on exports, demand may get impacted slightly, but in our case, since we are banking more on the export to quota network, so maybe we'll not see that sort of impact, but the industry may see.
Okay, this quarter our exports through Kubota was more than 40%. What is the number going forward that we're expecting through Kubota channel?
So right now we are projecting a similar level as we have seen in the last year. So once we open more countries and there's a lot of work needs to happen on the product side. So once the product is ready, then obviously you'll see the numbers going up. So that will take some time, but definitely I think the current product portfolio what we have, which we are already exploring, and there are certain new markets which are opening this year. So we expect the numbers should gradually continue. So it will be in the range of 30-40% range only going forward.
Got it. And one last question, sir. So I also wanted to understand the reason for our poor volume uptick in the construction equipment segment this quarter.
Poor volume uptick. Why do you say that?
As compared to the industry, the growth of our volume.
So essentially because of the product mix which we have, if you look at our main product portfolio is in the pick and carry crane segment, where we have done almost at par with the industry. The issue is on the backhoe loader, which is the earth moving segment. Here we are a very small player with about 1.5 to 2% market share. And the maximum growth in the industry has happened in that category. So it's more in terms of the issue in terms of the mix with the industry has and what segment has grown, where we are not very strong player. So that's why in the served industry, it looks like as if we have been dropping the market share. But if you look at our own pick and carry segment, actually in this quarter, we almost gained our market share back to 40% plus, which is the largest segment for us.
Got it. Thank you so much for clarification.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Sir, thank you for the opportunity. Sir, I have a question on your yearly guidance of single-digit growth for the industry. Sir, in view of festival being not there in April this time, in March, so last year April had a festival, so base was high. Even for this quarter also base for coming months, May, June remains high. Overall climatic situation is still adverse. and untimely monsoon. So despite all those negative factors, fundamentally right now, on what are the factors you think would help driving single-digit growth?
So Mitul, if you heard the commentary from Prateek, I think he mentioned in this quarter, since we already seen April has declined, the industry has declined, and May we expect to be almost flat industry, and June probably we'll see growth coming in. So overall for the quarter, we are anticipating flat industry this quarter. The low single-digit growth we're talking about is for the full year basis. So which is in the
My question is on full year only. I asked that this quarter we are saying flat and full year we are saying growth.
Yeah.
So these are the negative factors. Even in fact, inventory level is also high for the industry, which probably may come down slightly. So adjusted for that, wholesale growth, you are indicating single digits. So that's what I want to understand.
No, so Mitul, if you take a look at it, there are three positive factors that are impacting the industry today. One is the good MSP prices that we have, as well as the crop. The second one is the reservoir levels, which are significantly better than what we had in the last year. The third one, and the most important one, is the fact that it is an election year. But we expect infra spend, as I indicated, is doubling this year as compared to the previous years. So the haulage plus the mix segment, which accounts for close to 30% of the total industry, is expected to give a big boost to that particular entire space. That combined, so that infrastructure growth and hence a significant boost in the 30%, 35% of the market, plus a growth in agri because of MSP increase as well as irrigation, water reservoirs, that is expected to give you that single-digit growth.
Okay, sir. And second question again on the same in terms of per the commentary, it seems that second half would see the growth. First half may not be very great. In terms of region-wise, where do you see high growth coming, or which regions do you see still have some weakness? Because this monsoon impacts to be more in the northern and central belt, where we are relatively stronger compared to south.
No, I look at it. I think the growth we are expecting is going to be pan-India. That is one. And second one is monsoon is, if it comes, and I'm not sure what the outlook is going to be, but I think it will impact most of the geographies if it does impact. In fact, the irrigation in the northern and the western zones are actually better than some of the other areas, if you see the historical trend. So we feel a lesser impact to happen in our strong markets.
Okay, sir. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Hitesh Goyal from CLSA. Please go ahead.
Yeah, thanks for taking my question, sir. First question is on this tractor margin, which has improved 160 bips Q on Q. You had highlighted in the last con call that there is not much commodity cost benefit which you're expecting in the fourth quarter, but the commentary seems to be you've got some benefits and that will flow through in the next quarter. So is it mostly commodity benefits that has helped margins, or it is also the mix to some extent?
So it is the three reasons we mentioned. One, we also mentioned last quarter, since we taken the price increase after the festive season was over. So the full impact in the last quarter was not visible, which you got the full impact in this quarter, which it still is almost 0.75% end of the margin improvement. And then second, the softening of commodity price had happened. So obviously there is some decline which happened, even though last time it was not visible. But during the quarter when the rate got settled with the competition, and the leader who actually, take the lead in settling those rates on the commodity side. So we did get some benefit which happened towards the later part of March. And that's why we got the impact on the full quarter, and that impact will continue in the coming quarters too. And third is the product mix, which is also positive, because if you look at the trend, the more than 40 HP sales number into the percentage has gone up by almost 3% in this quarter. So that also contributed to the better realizations. So all three factors were responsible for the improved margin trend in the tractor business.
And sir, my second question is on this, which Harish also highlighted. Actually, irrigation intensity has improved quite dramatically, especially in states like Madhya Pradesh and all that. So I did an analysis that only, I think, Maharashtra and Karnataka and to some extent Gujarat is the areas where monsoon can have an impact on tractor, volumes if the water levels are quite high. Is the analysis, right? So we should not worry too much about monsoons at least because it's only reservoir levels are only the lower in UP, Bihar, where anyways the irrigation intensity is very high. Is the analysis right?
No, broadly in line with what we are also thinking, that we don't feel there is going to be a significant impact of monsoon this particular year because of the reservoir levels across most areas, which are key markets for us, being reasonably good. And plus, as I said, the infrastructure growth, which is happening because of the election year.
Great. Thank you. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on the strong margin performance, both in agri and the construction equipment space, and very heartening to hear the improvement expected by end of the year. Sir, couple of questions. Firstly, on Kubota Agri Machinery, if you can share your thoughts on the timeline for merger, and also is the progress happening on the localization part? Would you see that exercise completing within the 2-3 year period and seeing a bit margin of 15%? And again, on Kubota Agri Machinery, how do you see the component exports to global Kubota? What are the efforts there, and on a pilot basis, have you started exports?
So Raghu, on the merger front, right now we are waiting the approval from SEBI. So we had filed our application and all the stock exchanges have given all the queries were resolved, and the matter has been referred by stock exchanges to SEBI now. So we are yet to have received the approval. It's almost now close to 3 months is pending with SEBI. Once we get the approval from SEBI, then it will be filed with NCLT for the necessary processes. So it will take another 6 months' time. So right now, the way things stand, it looks like the process call gets delayed by another 3 months. So earlier we expecting it should happen by September, October, but the way I think things are today, so SEBI has already delayed this whole process. So it looks like it may, go somewhere around December, January types, assuming everything comes in line in future. On the localization front, so obviously the localization in the JVs is essentially for the Indian manufacturing, which is the major part, which right now is getting imported, and also other products which are right now traded. Because in the manufacturing JV, we are only doing 2 models for them right now, and the balance of the models are actually imported from Japan. So that localization will happen for the more product that's introduced in the portfolio, which will happen, I think, over the next 2-3 years, as you mentioned, because we have already factored that in our midterm business plan, which was unveiled to the investors and analysts last year in November. So that obviously is very much on. So the work is happening on that front. On the component export, so it's already the manufacturing JV is exporting to some of the countries, including Thailand and US market. And as they grow and develop more components and do more indigenization, so the opportunity for export will also further increase. So that is also already indicated, and that will continue. Obviously, the visibility to numbers will only happen when the merger happens. So right now, because they are still standalone entities, and we only consolidate the bottom line numbers there, so that is not really reflected right now. But since the integration happens and the merger happens, I will get to know more, I think, about them.
And the effective date will be from 1st April, right, sir?
Yeah, appointed date is 1st April 2023. So as and when it happens, so we'll do the consolidation of results from 1st April and produce consolidated results.
Kubota Tractors is selling in the network of 300 odd outlets. Any thoughts on cross-selling using the Escorts, Farm Track or Power Track network?
Yeah, so like we mentioned, so this is one of the key synergy which is there. So when the integration happens, so definitely there will be a opportunity for the dealers of both the companies to do cross-selling. So the good dealers on Kubota can also sell our products, maybe through a different showroom, not in the same showroom. And same thing can happen with our dealers also. So especially in the north and central India where we are strong and Kubota is not very strong, so that will give them also an opportunity to get represented through our network.
Thank you, sir. And on the construction equipment and railways, if you can talk about outlook for FY24.
So Sanjeev, you want to talk about construction, then Ankur can take the railway.
Yeah. Thank you, Raghunandan. So this is Sanjeev Bajaj. I want to talk about construction equipment outlook for this year. Now, last year we've seen that the first half was very subdued, and second half only we saw that the demand came up, and we expect that the speed at which the projects are moving at present and the demand from the project infra projects is very, very high. So this year it is expected that the same level of demand will continue. Although there was some backlog which was to be covered in the last quarter for the first half of the year. Second half of the year, this year we expect that the industry will continue to grow. Our server industry will grow at about 10 to 12% is what we are expecting. And we see that till the end of the year, this demand should continue except for the small period of monsoon when the projects actually go into halt.
Yeah. Hi. Good evening, Raghu. This is Ankur Dev. So regarding railway business, so as of now, we have a strong order pad of 1,000 crore plus, as we mentioned in our opening remarks. Most of this will be executed in current financial year only, financial year 24. Additionally, we are going to commercialize 3 more products which were in field trial in the last financial year. And obviously, these commercialization of these 3 new products will add to order pad and the revenue in the current financial year. So overall, I can say that we will continue this growth momentum in railway business, and we are hoping that we will be able to grow by double digit in the current financial year also. Thank you.
Thank you so much, sir. And to Ankur, sir, if you can talk a bit on the localization efforts of new products and how the margin trajectory will go ahead on railways.
So regarding localization, as of now, mostly it is in the brake side for the LHV coaches, and we have already done the localization of the components which we are importing as of now. So all those localized components are put into the field trial as per the Indian Railways regulation. So we expect that this localization benefit will flow into our margin in financial year 25, basically the next financial year.
Do you see margins going back to that historical highs of 18 to 20%?
It is difficult to say exactly to those high levels because we have been impacted by the inflation in the metal cost in last 2 years. But obviously, we are working towards that.
Thank you, sir. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yes, sir. My question is, with the Escort Kubota tie-up in place, what kind of opportunities does open up from a product perspective, or what kind of gaps gets plugged from a product perspective? And over the next 3 years, alongside exports, this 95,000 or 100,000 tractor volume that we see, what kind of volumes are possible on a 3-year basis? If you could just give a small recap on that.
So Pritesh, we already unveiled our midterm business plan, so maybe you can have a look at that. It's already available on our website. It gives the overall picture in terms of where our aspiration is to go. Not exactly 3 years, we're talking about 5 years there by FY28. It's both on the domestic front, export front, like outsourcing opportunity which exists for EKL, which Kubota intends to use both on the component side as well as on the finished good side. So I think all those questions are getting addressed over there. So it's difficult to put a number right now in terms of what will happen, but obviously the idea is to make sure wherever the white spaces exist in the product, so that gets addressed. And there's also opportunity to obviously do a joint development of products, which there's a plan. So most of the products introduction will happen by FY26, as I think it stands today, and the projects are on, and it includes both the products on the domestic side as well as for the export market.
Most of the product introduction will happen by FY26.
For the new products, which is totally under new development, but there are many opportunities which will be in terms of tweaking the existing product platform, so that will happen sooner. So every year you will see some new products coming into the play.
Okay. I'll go through the presentation. Thank you very much.
Thank you. The next question is from the line of Manoj Bhat from Motilal Oswal. Please go ahead. Mr. Manoj, I have unmuted your line. Kindly proceed with your question. As the current participant is not answering, we move on to the next question, which is from the line of Kapil Singh from Nomura Group. Please go ahead.
Yeah, hi, good evening, sir. Just follow up on the TREM 4 norms. How much was the cost increase that we did for more than 50 HP segment, and were we able to fully pass on this cost increase? And did that have any impact on volumes for this segment?
So Kapil, the impact is roughly 10 to 15% of the total cost of the tractor. It's on the higher 50 HP and above tractors. So on the emission norms are already been put into place. So last part, since the norms become effective only from 1st of January, and most of the manufacturers were carrying inventory, so really the impact has not been seen. Now, whether this gets absorbed in the market or not, I think we'll come to know in the coming quarters. So I think it's difficult to say at this point in time, but definitely no one would like to keep the cost on their P&L, so everybody would like to pass it on to the market.
So we have already taken 10 to 15% price increase?
No, so like you mentioned, most of the manufacturers are carrying inventory of the old tractors with the old engine. So once the new emission norm tractors start coming to the market and start getting retailed, so really we'll come to know. But yes, the price increase will happen based on this cost increase.
Okay. And by when is it expected that the new tractors will start coming into the market?
I think from this quarter you should start seeing the impact.
Okay. The second question was on exports. April saw pretty sharp decline. Any particular reason? Was there any one-off, or do you think that exports could be soft this year?
No, so export will not be soft. We have order book. We had more than 800 tractors ordered actually, but it could not be completed because some model mix issue and supply chain issues were there. But they will get it in the coming months. So there's no shortfall as far as the order book is concerned for export. I think it was only temporary issue in the line and some quality issue which are getting addressed. So that should actually get taken care of in the coming months.
Okay, so is it already addressed, or it could, like, by when do you expect that this would be addressed? The issues that we face
have been addressed, so you will see the impact coming from the coming months.
Okay, sir. Thank you. That's all from my side. All the best.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. A couple of questions from my side. One is the RM cost savings you expect it to continue in coming quarters, and what materials are we seeing further moderation from where we are today?
Yes, we expect the softening will continue. So we are seeing, I think, already seen the news clippings on the sheet metal. The steel companies are talking about reducing the prices by about 1,500 to 2,000 rupees per ton. On the costing also, we're seeing some softening is happening. So both on the coke prices and this pig iron, both are going down. So we'll see some softening happening on the costing too, which is a major component for the tractor industry. We also seen the rubber prices going down. So where we've seen the results of the tire companies, most of the companies have actually seen the margins going up in last quarter. So hopefully, since we get the impact with some lag, so that should also start benefiting, the company. So to your question, yes, broadly we see the trend is downward on the commodity side. So we should continue to get that impact as the quarters pass by.
Okay. And in that context, we would not have taken any price increase in fourth quarter or till date in 1Q.
Yeah, so industry hasn't taken any price increase because the prices are coming down. So net basis, if you look at whatever the inflation has been there, it's been fully passed on to the market by the industry, including us. Yes, the margin on that increase has not been absorbed by the market, and no one has been able to pass it on. So that is why we're seeing the cost-wise, percentage-wise, the material cost is looking very high compared to what it used to be 2 years ago. So I think as the softening happens, we'll see the gradual increase will start happening on the margin front too.
Got it. And lastly, with respect to the merger of those two entities, can you clarify what kind of impact it will have on margins and profits based on FY22 numbers or other indicated on FY23 basis?
So I think it's already there in our investor presentation on our website. So we have given the consolidated view of FY22 numbers. So based on both the JV's numbers. So broadly, if you look at the last year's number, there was a dilution of happening in the EBITDA margin of about 1.5 to 2%, where they were still almost break-even sort of operation. So I think once the merger happens, a lot of cost synergies which will flow in. So as you keep cutting down the cost, the margin will continue to improve going forward. So end objective is they should also continue to come back to the same level of margin what we are doing in EKL on the tractor business. Obviously, there will be some difference because the positioning for Kubota brand is different than what EKL has. So to that extent, there will be some difference should be there. But overall, blended margin should be actually in the same range as the tractor industry enjoys.
Okay. And given that this is happening in FY24, impact might be much lower than 1.5 to 2 percentage points at EBITDA level. Would that be fair?
Or it will be similar.
You mean similar dilution of 1.5 to 2 percentage points because of...
Yeah, but they'll continue to be in the same range, so there's no major change there because of the margin profile.
Got it. Okay, sir. Thanks and all the best.
Thank you. The next question is from the line of Jyoti Singh from N Capital Market Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, as most of my question got answered, so I just have one query. So how is the traction we are seeing on the non-automotive side?
Non-automotive means?
Non-agri side.
Non-agri. Okay, tractor users for non-agri you're saying.
Sorry?
Are you talking about the tractor users for non-agri purposes?
Yes, sir.
Okay.
So two parts to it. As I mentioned, the tractor uses for non-agri purposes is going to see a boost this year, at least that's our estimate, given the increase in infrastructure spends, which is a doubling as compared to last year. Point number one. Two is, starting from Q2 of last year, we have had an increased focus in this particular segment, and we are consistently seeing a growth of share within that segment. We will continue to focus on the segment for F24.
Okay. Thank you, sir.
Thank you. The next question is from the line of Samir Deshpande from Fairdeal. Please go ahead.
Good evening, everyone. And Mr. Bharat Pradhan, congratulations and welcome on the board of Escorts. You really deserve the seat, and I'm happy that you are there. And I hope the company prospers even better under your stewardship. Now, the question is actually, we have a capacity utilization of around 90%. And we have sold 1.03 lakh tractors this year. So we have, I think, around 1.10 or something as a capacity. Now, we earlier, when we had with Kubota, we were planning to increase the capacity by about 50,000 tractors. So what is the status of that at level of that?
Yes, Ameji, you're right. So our own capacity in EKL was close to 120,000 tractors. And with JV, we have another 50,000 tractors capacity, out of which roughly 30,000 capacity was available for users by EKL also. So overall, we had about 150,000 tractors capacity. So right now, we are at 103,000 this year. So capacity-wise, we don't see an issue on an immediate basis. And as we had indicated in our midterm business plan, there is a plan to double this capacity in next 5 years. and this is one of the key projects as part of our midterm business plan. So we'll be increasing the capacity from 150 to 300,000 tractors by setting up another greenfield venture within this next 5 years period. So that will be on. So obviously we'll ensure there's no shortage of capacity in terms of what we need in terms of the requirement. This 90% capacity is only in this quarter of March. So overall the utilization level is not 90%. So that's why it's more seasonality which comes into play. So there are options to keep the inventory build up if the requirement is there for any particular season quarters or season months. So that can be done. So overall, so we don't see really from capacity perspective it will be an issue. But yes, there are already plans to expand the capacity further.
And now with this regarding margins and tractor industry outlook, I think it mentioned that mid-single digits growth is possible this year, despite this El Nino specter, etc., because of the good water levels and overall irrigation improving, etc. That is good. Good to hear. And even the tractors in the non-agri segment also expected to have a good sales boost with the election there. That is good. But the margins you mentioned that currently we have about 9.8% in this quarter for tractor segment margin. So you I think mentioned that earlier we had about 14-15% about 1 year back, 1.5 years back. So are we likely to return to those levels by the end of the year?
Yeah, that's what I indicated. So both I think we're expecting the commodity prices continue to soften, and then also some benefit which will flow in from some of the cost initiative what we have undertaken this year. So both put together should lead us to a situation where we end the year, with this sort of margin profile, which used to be there for the tractor business for us.
So it will keep on improving sequentially. Segment margins will go on increasing sequentially.
Because the cost impact, whatever cost initiative company takes, the impact will be maximum in the last quarter, because every quarter will keep on accruing. So definitely in the last quarter we'll see the maximum bit coming in. So we think when we exit this year in the last quarter, so we should be in that range.
And the last question is in our balance sheet, we had last year under current investments 4,587 odd crores, and now that has almost 2,785 crores has shifted to non-current investments. So what actually does it mean?
So immediately it's only a classification issue where the investment which is held for more than 1 year is shifted to non-current. Otherwise the overall investment portfolio remains same. So we have close to 4,800 crores of liquidity on the balance sheet which is invested in this debt mutual funds. And that's excluding the escrow account. So overall, if you include escrow account balance, it will be more than 5,000 crores at the end of March.
Okay, quite good. And in construction equipment, really after a long time we are seeing very good results. So 35% of the capacity utilization at volume of around 4,600 odd. We have been in a position to turn around and make some 3% odd margins. So if the capacity goes up by around 30-40% more, during the election year, maybe 20-30% more, can we see the margin cross 5 to 6%?
So Samiji, capacity depends on what product we are selling, because there's a demand maybe for different products. So with some of the products we are facing shortage of capacity today. So there's a capacity constant, especially on the safe crane part, which is one of the key component, which is a high margin product for us. So there we are actually not able to produce, which is why we saw some of the spillover happening from last quarter to this quarter of some volume. So overall capacity looks like there's an issue because backward loader we are not doing much. So there we have surplus capacity, but where we need capacity, there we have some shortage. So don't look at overall number, but that is the combined capacity which is reflected in the presentation. But individually basis is something what we need to really track in terms of seeing how much we can grow.
Thank you and all the best.
Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. A request to all the participants, we would request them to limit their questions to 1 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Deepak Jain from Enam AMC. Please go ahead.
So you were having some product mix issues few quarter back. So are they being addressed? And in context of that, this 14% EBIT margin for the exit quarter, will it come entirely from the cost moderation or some other price hikes or some product mix improvement element will also be there?
So it will be a mix of both, I think multiple matters. So like we mentioned, the cost initiative is one which we are looking at. Then there's also some softening of commodity prices which we are expecting will happen. So that will also lead to improvement in the margin. And on product mix, I think it's compared to what we were earlier, we think some improvement which has happened in last quarter also. And same trend was there in April too. So we hope if that continues, so that will only help us in getting there earlier than probably last quarter.
Okay, sir. Thank you.
Thank you. The next question is from the line of Ayush Agarwal from Molecule Ventures. Please go ahead.
Hello.
Yeah, please go ahead.
Yeah, hi sir. I wanted to ask about the commodities. The commodity prices you said are expected to go down. So in that, which commodities are you expecting the prices to soften in rubber, castings and?
Casting, sheet metal and rubber prices, I mentioned.
Okay. And could you please give us some idea about how much of the cost of our company would be coming from castings and rubber?
So I think we indicated in last call also, last quarter, so it's almost 50 to 60% cost comes from these two commodities between rubber and tires and castings for tractors. Which is why you did not see the impact what we saw in the auto industry. We did not see that impact coming in the tractor industry.
So casting separately, could you give us an idea?
Sorry?
Casting, you said casting and rubber is 50% around. So
yeah.
Casting alone would be around?
Almost 40%, 35 to 40%.
30 to 40%. And over the past also, the current in FY23, how has the prices gone?
In FY23, as you all know, I think once the geopolitical issue happened, so in the March, April, we saw very steep increases in the commodity prices. In single quarter, we had seen almost 4 to 5% increase happen in this material cost for us. And only the prices started coming down from Q3 onwards, very marginally. It's only happened in sheet metal likely first. In casting, the price cut has only happened now. So some impact we saw in Q4. And then probably something will happen in this quarter too. But it's not a major change this has happened in the casting front. So that's why you're not seeing major impact coming on the commodity savings in the tractor industry.
Right. At castings, we have more than 3 suppliers or are they consolidated?
No, there are multiple suppliers for casting. There are many suppliers. Yeah.
Okay. Thank you.
Thank you. We have a follow-up question from the line of Devika Jain from Ratnabali Investment. Please go ahead.
Thank you for taking my questions again. So I wanted to understand how and by when will we deploy the cash balance and where exactly, where primarily?
So Devika, you can refer to our midterm business plan. We've given a capital allocation strategy there, how the money will get utilized. There's obviously the capex plan by the company. There's certain money which we got from Kubota is meant for using in the business only. It's not meant for distribution. So that was the purpose of that money which was being raised. So we had given the indication how much will get spent on capex and how where the greenfield project has to come up, will be additional capacity will get created. And then within the existing facility, a lot of changes are happening and the real layout is happening there. And the product development, which is another major spend which will happen on the multiple products which will get introduced both for domestic market as well as for export market. So net, we have given the overall indication what will be the capital allocation strategy the company will deploy, including in the sort of distribution, the payout ratios, the buybacks. So everything I think is spelled out there.
I basically wanted to understand when will we start seeing some movement?
Yes, it will happen gradually. You can't expect to happen overnight. So obviously, as you see the improvement happening of the performance also, and the numbers start looking up, so these things will also, start getting better. So you've seen the dividend itself this year. We maintained the same ratio as last year, which in the payout actually has gone up compared to what we had last year. So idea is to gradually move up to the level what we had indicated in our midterm business plan.
Okay, and if we have any inorganic opportunities that we are exploring?
So if something comes to us, definitely we'll look at that.
Okay, thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to Mr. Bharat Madan for closing comments. Over to you, sir.
Thank you, ladies and gentlemen, for being present on this call. For any feedback and/or queries, please feel free to write into us at investorrelation@escortskubota.com. Thank you very much and have a good evening.
Thank you, sir. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you. Goodbye.